Hey everyone, welcome back to Corporate Decoder. Today, Hartford Funds Exchange. Traded Trust just filed its N-CSR report for April 2026, and I'm spotting a few interesting takeaways about the Hartford Equity Premium Income ETF, or HEMI for short. Quick note, this is not financial advice. Just my take on public filings for educational purposes. This filing gives us a peek under the hood of how this ETF is performing and what it is invested in, which is super valuable for understanding where your money might be going. This report is all about the Hartford Equity Premium Income ETF, or HEMI. It covers the period from when the fund started operations in December 2025 up to the 30th of April 2026. Think of this as a semi-annual report showing you how the fund is doing and what it holds. One of the first things people want to know is how much it costs to own a piece of this ETF. They show here that for a hypothetical $10,000 investment, the costs over this 6-month period were about $19. That is a really tiny amount, about 0.49% annualized. This is pretty standard for ETFs, meaning the ongoing expenses to run the fund are quite low. Now, let's look at the fund size. As of the 30th of April 2026, the net assets for the Hartford Equity Premium Income ETF were $32,783,911. That is a good chunk of money, showing that a lot of investors have put their trust in this fund. The total number of holdings was 86, meaning it is diversified across a decent number of different companies. This next part is where we see what the fund is actually invested in, broken down by industry sector. The biggest chunk, a whopping 33% of the fund's assets, is in information technology. This means the fund is betting heavily on technology companies. Then we have communication services at 12.4% and financials at 11.3%. Consumer discretionary and industrials also make up significant portions. It's clear this fund is leaning towards growth sectors. Now we get into the nitty-gritty of the actual stocks they own. This is the schedule of investments, and it tells us precisely what companies are in the fund. For instance, under consumer discretionary distribution and retail, they hold a significant position in Amazon.com, Inc., with a market value of over $1.8 million. They also have substantial holdings in other major tech players like Alphabet Inc., Class A, valued at over $2.4 million, and NVIDIA Corp, where they have a stake worth close to $3 million. This confirms their heavy tilt towards technology and large cap growth stocks. What is also interesting here is the Note 1, next to many of these holdings. It says all or a portion of the security was pledged as collateral in connection with written option contracts. As of the 30th of April 2026, the market value of these pledged securities was over $13.5 million. This is a key part of how this particular ETF, the Equity Premium Income ETF, aims to generate returns. They are selling options on some of their stock holdings to earn premium income. Speaking of options, let's look at the exchange traded option contracts. They have written call options on the SPDR S&P 500 or SPDR S&P 500. These are essentially contracts where the fund has agreed to sell the underlying security at a certain price by a certain date. The total value of these written option contracts is about $47,000. And the fund received premiums for selling these options, totaling around $54,000. This is the income generating part of their strategy. The unrealized appreciation or depreciation on these options shows how their value has changed. They also have some futures contracts outstanding, specifically an S&P 500 E-mini future. This is a way to gain exposure to the S&P 500 index. They have 21 contracts with a notional amount of over $760,000, and the current value showing an unrealized appreciation is about $35,000. These are common tools for ETFs to manage their exposure or implement specific strategies. This section breaks down how the fund values its investments. Most of their assets, over $31.8 million, are categorized as level 1. This means they are valued using quoted prices in active markets for identical investments. Things like common stocks and futures contracts fall into this category. Their short-term investments and written options are valued at level 2, meaning observable inputs, other than just quoted prices are used. It is good to see that the majority of their holdings are valued using readily available market prices, which makes them pretty transparent. Looking at the statement of assets and liabilities, we see the fund's financial snapshot as of the 30th of April 2026. Their investments in securities are valued at $31.8 million, and they have about $941,000 in cash. The total assets are over $33.1 million. On the liability side, they have payables for things like investment management fees, totaling close to $317,000. The net assets, which is what the fund is worth after subtracting liabilities, comes out to $32,783,911. Matching what we saw earlier. This statement shows the fund's income and expenses over the period. They earned about $74,000 in investment income from dividends and interest. Expenses, including investment management fees, custodian fees, and audit fees, came in at around $61,000, but they had expense waivers of about $22,000, bringing total expenses down to about $38,000. The net investment income was about $35,000. Now, for the really impactful numbers, the gains and losses. The fund had a net realized loss on investments of over $455,000. This is from selling assets for less than they bought them. They also had realized losses on futures contracts and written options. However, the story really changes when you look at the unrealized appreciation. The fund saw significant unrealized gains on its investments, totaling over $2 million. This means the value of the stocks they hold but haven't sold has gone up. They also had unrealized gains on futures contracts and written options. The net effect is a substantial net gain on investments and other financial instruments of over $1.3 million for the period. This is what drove the overall increase in net assets. This statement shows how the fund's total net assets changed over the period. The net increase from operations was $1.38 million. They also had distributions to shareholders totaling about $734,000. Then there were capital share transactions where they sold shares worth over $32 million and redeemed a very small amount, leading to a net increase from these transactions of over $32.1 million. All of this combined resulted in a net increase of $32.7 million, bringing the ending net assets to over $32.7 million. Looking at the financial highlights, we can see the per share data for the period. The net asset value at the beginning of the period was $40 per S-Hair. The net investment income per S-Hair was about $0.07, and the net realized and unrealized gain on investments added another $2.07 per S-Hair. This resulted in a total from operations of $2.14 per S-Hair. After distributions of $1.16 per S-Hair, the net asset value at the end of the period rose to $40.98 per S-Hair. The expense ratios are telling here. The ratio of expenses to average net assets before adjustments was 0.78%, and after adjustments it was 0.49%. This 0.49% is the actual cost to the investor, aligning with what we saw at the beginning of the report. The ratio of net investment income to average net assets was 0.45%. This shows how much income the fund is generating relative to its assets. The portfolio turnover rate was 22%. This is a moderate turnover, meaning they are buying and selling some holdings, but not excessively. Diving into the notes to the financial statements gives us more context. They explain that the fund is an open-end investment company that invests in stocks and uses options to generate income. The NAV is calculated daily. They mention that investments are valued at market value when available, and if not, they use fair value procedures approved by the Board of Trustees. They also go into detail about their derivative instruments like futures and options, and how they are accounted for. They have a substantial mention of their use of written call options on securities, which is how they aim to boost returns. This touches on a key risk: foreign currency and market fluctuations. They acknowledge that while they invest in a variety of assets, the value of foreign securities, or those denominated in foreign currencies, can change significantly, especially on days when the US markets are closed. This highlights the global nature of investing and the inherent risks involved. This is a crucial detail on how they manage risk. They report the gross amounts of derivative assets and liabilities. For futures contracts, they have assets of about $35,000. For written options, they have liabilities of about $47,000. Importantly, these amounts are not netted out in the main financial statements. And they highlight that they are not subject to master netting agreements, meaning if a counterparty defaults, they can't simply offset these amounts against each other. Looking at the end of the filing under item 11, which discusses the basis for approving the investment advisory contract, we see a section on other benefits. This part of the filing discusses how they consider if the investment advisors are benefiting excessively from their relationship with the fund. They reviewed the nature of the services, the performance, the costs, and profitability. It is a look at the checks and balances in place to ensure the fund is being managed in the best interest of shareholders. They also note that Wellington Management, the sub-advisor, had fees that were negotiated at arm's length and paid by the main investment manager. Hartford Funds Management Company LLC, not directly by the fund. This is a pretty standard part of the filing where they discuss how the fund fits into the broader Hartford Funds family. They consider the opportunities for investors and how the fund is managed to benefit shareholders. And in a significant update titled Subsequent Events, there is a major announcement. On the 3rd of June 2026, the Hartford and Wellington announced an agreement under which Wellington's parent company will acquire Hartford Funds Management Group, Inc., which includes the investment manager for this fund. This is a big deal. The deal is expected to close in early 2027, and if approved, the fund will continue to be managed by Wellington. This signals a potential shift in the management structure of the fund. The whole section on the basis for approval of investment advisory contract is really important. It details why the Board of Trustees decided to approve the management agreements. They looked at the nature and quality of the services, how the fund performed even using simulated back-tested results, the costs involved, and whether the advisors were making excessive profits. They compared the fees to similar funds and considered economies of scale. This entire section is about due diligence and ensuring the fund is managed ethically and effectively. So, what's the story here? The Hartford Equity Premium Income, ETF, or HEMI, is a growth-oriented ETF heavily invested in technology. It uses options writing to generate additional income, which is a key part of its strategy. The financial statements show it experienced significant unrealized gains during this period, boosting its net assets. A really big development is the pending acquisition of the fund's investment manager by Wellington Management, which could bring new leadership and approach to the fund in the near future. The risk I am watching is how the shift in management might impact the fund's strategy and performance. Also, given the fund's heavy tech exposure and reliance on options income, market volatility could introduce significant swings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like this video, comment your thoughts, and subscribe for more insights. Join our Discord community. Link in the description.